Well, hey there, everyone. Happy Tuesday, October 21st, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you every trading day after the close to help you make sense of these markets, help you build better routines, have a little more discipline in your decision making, and just appreciate the benefits of technical analysis and what we call behavioral investing, getting inside our own heads and making sure that we're making good decision with the tools we have available to us. Today, kind of a choppy day on Wall Street. The S&P opened weaker, traded higher, traded lower, traded higher, traded lower, and by the end, literally 0.22 points away from yesterday's close. That rounds out to a 0.00% change in the S&P 500. It was an unch day from top to bottom. Now, plenty of noise, plenty of movement, and when we dig underneath the hood a bit, looking at the market carpet, you will see that there are quite a few names moving to the upside and the downside. Alphabet, one of those growthy names we're going to talk about. We'll hit on some others as well. Hope you guys are all doing well. As a reminder, we're available for questions at all times. We can't get to all the questions that come in, but I appreciate you using the comment section on our YouTube channel. If this video elicits any questions, if there are any things that we haven't looked at that you think we should, if there are particular tickers that you'd like us to take a look at, make sure you drop a comment on our YouTube channel and let me know. We are planning an all mailbag edition on Friday. We'd love to answer one of your questions as part of that episode. All right, let us get to the market recap. So here's what happened today. The S&P, as I mentioned, choppy, sloppy. So this was yesterday with a nice rally finishing toward the highs of the day. We opened weaker. We traded higher by lunchtime. We're looking pretty good above 67.50 soon after. We're back below yesterday's close. We chop around again. That late stage sell-off puts us right back almost exactly to Monday's close, 67.35. The Dow about 0.5% higher. The NASDAQ composite slightly lower. We can see mid caps and small caps both slightly in the green, but this is not a big directional day for any of the major equity averages. Volatility continues to come in, right? When we think about red flags, right, what are the things that tell us heightened chances of a deeper deterioration? A spike in volatility is one of those classic ones, right? The VIX usually doesn't spike, and then people calmly are just kind of chilling out and thinking maybe the market might go down. A spike in volatility usually implies a spike in fear, which usually means prices are going down. So when the VIX spiked above 20 earlier in the month of October, certainly through last week, big red flag. The fact that the VIX went back below 20 on Monday, remaining below there today on Friday, a very good sign, right? So if you're on the bullish side, that VIX remaining below 20, one of the key metrics to look for. We'll see if that continues. For now, looking pretty decent. Some interesting movements in the bond markets, which you're going to see if you look at the chart of the 10-year Treasury yield, which is $TNX on stock charts. You will find a consistent downtrend phase. Bond prices rallied yet again today. The TLT was up about 0.5%. 10-year Treasury yields, and in fact, the entire yield curve generally drifted lower today. So we have bond prices going up. We have rates coming down. That's in line with what you would usually expect, given the fact that the Fed is set to lower rates again at this October meeting. We'll see. We've got the CPI data coming in this Friday. We've got the Fed meeting later this month, and that would be the last Fed meeting until December, which will be the final one for 2025. The markets for now pricing in another 25 basis point cut at this October meeting. We'll see what happens between now and then. The dollar slightly higher, not much, right? Less than 0.5% up, but dollar continuing to strengthen. Big move today in precious metals, right? Gold, the GLD down 6.4%. That is a big downdraft in gold, coming off of a new all-time high yesterday. On yesterday's episode, we talked about how far gold was from its moving averages, how that often means we get some mean reversion. We definitely got that today. Silver, the SLV, down 8.25%. Now, are those big down days? Absolutely yes. Does that take us below the 21-day EMA, which is our initial warning sign? Yes for silver, not for gold, as you'll see when we look at the charts here in a short while. What you have to remember is when things like gold and silver have had the parabolic rises that they've had, one big down day certainly, loses value from the peak. But we're still up quite a bit in 2025. So let's put it into proper perspective. But as trend followers, we're always looking for signs that the trend is changing. So we'll spend a little bit of time on the gold and silver charts today, kind of evaluate some of the basic, levels that we can follow and understand, try to put today's significant drop into proper context. Copper going down as well, down over 2%. Crude oil actually having a pretty decent day. And while energy stocks were not particularly strong relative to other sectors, we are seeing a bit of an uptick in crude oil and natural gas prices. Cryptocurrencies, Bitcoin looked really good earlier today. Bitcoin traded up to 114,000, currently trading just below 111,000. So it's given back a little bit from that gain. Overnight did get down to below 108,000 before rallying a bit higher. So continue to be a pretty volatile asset and a volatile chart. All right, let's look at the 11 S&P sectors. You can see consumer discretionary, the XLY up 1.2%. Industrials, the XLI up 0.9%. Communication services about 1/3%. Those are your three top performing sectors. 5 out of the 11 finished in the green. So sector breadth, not great, right? More sectors down than up. But it's some defensive stuff at the bottom of the list, right? Utilities down 1%, consumer staples down about 0.5%, and then on to some of the other defensive and more value-oriented sectors. So consumer discretionary having a pretty decent update. We'll see from the heat map here in a moment what are some of the names that actually were participating or helping to create that upside movement. All right, checking in on breadth conditions, pretty decent breadth day. The NASDAQ composite kind of neutral breadth, but if you look at the New York Composite Index, way more stocks up than down. When you go to the S&P large cap, mid cap, or small cap indexes, advancers definitely outnumbering decliners. What you'll see is that the McClellan oscillator finally back above zero after spending pretty much the entire month of October below zero. We're going to see an improvement in the percent of stocks above their 50-day moving averages. If you look at the advanced decline lines, hooking higher today. So, the bullish outcome from this choppy period we've experienced here in the last week or two would be improving price, improving momentum, improving breadth. Certainly getting some positive breadth readings today should be very encouraging if you're looking for something to be optimistic about. All right, looking at the Magnificent Seven and Friends leading growth names, Amazon at the top of the list, up 2.6% today. Netflix and Apple up about 0.25%. That's about it. On the downside, a couple charts struggling. Alphabet down 2.4%. I did grab that chart to look at a little later. Broadcom down 1.9%. If you watched earlier this month, I did a special event on Stock Charts TV, monthly exercise with Grayson Rose of Stock Charts, looking at our top 10 charts to watch for the month. Broadcom was one of the names I threw in there. So check out that episode. I don't think that's posted yet. Should be there pretty soon on the Stock Charts TV YouTube channel. But if you check that out, we'll talk about Broadcom and updating. Honestly, divergences have me a bit concerned on the chart of AVGO. Tesla down as well with earnings queued up for this week. All right, we're going to look at the market carpet. As a reminder, I appreciate your questions. Use our YouTube channel and use the comments section there. Any questions that come up as you're watching the show. I appreciate you guys so much tuning in. And would love to answer one of your questions as part of our mailbag episode Friday of this week. So keep them coming. Here's what the heat map looked like today, by the way. I mean, to be honest with you, as much as this was a decent day for the S&P, decent day for certain sectors, that is, particularly for consumer discretionary, the S&P was flat. And this is what the breadth, I think this is what the heat map should look like on sort of a sideways choppy day. I see almost a balance between stocks that were up, between stocks that were down, even in the mega cap names, right? With Amazon up 2.6%, Alphabet down 2.5%. Within, sector to sector, you're finding even within certain sectors, quite a bit of difference between stocks working and stocks not, even within the same group. So Raytheon making a new all-time high, up 7.6%. Lockheed Martin down 3.2%. So it was very much a choppy kind of transition type of day, I would say, more than anything. So let's focus in on some of the charts that I think are worthy of our attention. We're going to look at Alphabet in a little bit, so I don't want to talk too much about it, but I would say we're on major league divergence watch, right? Alphabet made a new all-time high on Monday, yesterday's session today, pulling back a bit. And the problem is, as we pull back from that previous high, you're going to note that the momentum is clearly diverging from the price. We're seeing stronger prices on weaker RSI, weaker readings. That's a bearish momentum divergence, usually pretty common at major tops in individual stocks, and certainly in the market as a whole. So Alphabet looking not particularly good. As much as the markets, in terms of breadth being positive, if you look at big tech, not a great day, right? If you look at Nvidia, Apple, Microsoft, Broadcom, Oracle, those are the top 5 weights in the technology sector. We continue on to Palantir, AMD, Cisco, I almost said Costco, Cisco, IBM, and Salesforce. Salesforce, which is without a doubt the worst of those charts, not even close, clear negative outlier. That was the only one that had a decent update, and that's coming off of a teasing new 52-week lows in the last couple sessions. So, not a great day. And charts like Micron, obviously still great, but pulling back today. So today was not a big resurgence in some of those growth areas. Consumer discretionary, though, very much a positive outlier. Look at Amazon bouncing as it's pulled back to retest the August lows. Look at cruise lines like NCLH. And again, not great charts yet, but I like the fact that they're bouncing higher. MGM and other gambling stocks having a bit of a bounce. So, a lot of these charts don't look particularly strong, I would say, from a technical perspective, but they're certainly rotating higher. We'll take a look at Lennar as one of those. Here's LEN, right? We talked about home builders a lot sort of in this August into September time period because the chart started to look incredibly constructive, right? Lennar broke down below its 200-day moving average back in December of 2024. Here in August, we finally break back above the 200-day moving average. We're making new 3-month highs. All is looking really, really good. But whatever trend line you drew back here, that's been broken. The 21-day broke, the 50-day broke. All of a sudden, we're testing the 200-day. But for now, that's held. Now we're sort of trapped in limbo between the 200-day moving average and the 50-day moving average, which lines up with the October swing high. How do you play a chart like this, or how do you approach it? For my opinion, this is one of those neutral charts. You sit on your hands, you're patient. You wait to see which way this thing breaks. For me, I would set 2 alerts. One would be above 130, which would be a bullish breakout above the early October high, above the 50-day moving average. I would set another alert for around 118, 117. That would be the October swing low and the 200-day moving average. One of those levels is going to break here probably pretty soon. And whichever one does, I would assume that's the direction of momentum. And as long as that breakout is supported by stronger momentum, as long as that breakout ideally is supported by stronger volume, that would be a good indication that there is a new impulse move in that new direction. So I think Lennar is one of those charts to sort of set some alerts. I'm actually jotting that down right now so I don't forget. What did we say? We said Lennar. All right, drawing that basic code on a piece of paper so I remember that. All right. Another chart I wanted to highlight here was 3M. This is in the industrial sector. Obviously, 3M is one of those kind of classic, big diversified industrial companies, right? I think like GE, General Electric back in the day, like the big conglomerate kind of name, classic industrial. When you think of like the Dow Industrials, when you think about Charles Dow writing about the Dow Industrials and the Dow Railroads, I think of 3M as one of those kind of classic names that would make sense in the Dow Industrials as a, kind of traditional producer of things. Making a new 52-week high today, up about 7.7%. This is on earnings today. Nice breakout. What's good about this move higher is it finally breaks out of this base. This is what one of my predecessors at Fidelity, the great Bill Doan, the great and late Bill Doan, made a career really out of identifying big base breakouts. He would look for stocks that were in a sideways consolidation period for an extended period of time. Alan Shaw, who ran the group at Smith Barney back in the day, would say the broader the base, the higher in space. The longer that a stock spends in that consolidation range, when you finally break out, that means something, right? Look at the chart and think behaviorally what this is telling you. Here we see the stock rallying up to around $160 a share, repelled, right? We see an exhaustion of buyers, no more demand, sellers, pushing the price lower, big bearish engulfing pattern there. We retest that 160 level. It fails. We retest the 160. It fails. We retest. See how many times we tested kind of 160 and we don't get any higher. That's why resistance matters. That's why we always look to see where a stock has turned before, because that's where sellers are coming in or buyers are not willing to pay more than a certain level until they are, right? And that's why a breakout above an established base, above an established level of resistance tells you something's different. This certainly appears to be related to earnings today. Stock up, obviously an encouraging earnings release, but the fact that it pushes us to a new 52-week high out of this base above that resistance level tells you there's renewed confidence. This is a new impulse move to the upside. And I would love to see tomorrow a follow-through day, additional accumulation, which tells you it's not just a one-day reaction, but something more significant. But I would say the setup in 3M, kind of encouraging there. That's just one of the names within the industrial sector. But I would say from Raytheon, one of those established uptrends, bouncing off of the 50-day moving average, another earnings name today, gapping to a new all-time high today. I think charts like that are pretty encouraging. And we can see elsewhere in sort of this aerospace defense theme. Here's Howmet Aerospace threatening a new 52-week high. There are some strong charts in that sector. And again, breaking above resistance, breaking above a base is encouraging. I'll be looking for follow through with any of those charts moving to the upside. All right, we'll finish off here looking at some charts together, shall we? Here's a daily chart of the S&P 500. No real change from what we've talked about here recently. What we've basically been saying is we know that the S&P is in an uptrend. We know that just by looking at the chart and seeing that it's going from the lower left to the upper right. We know that from measuring more specifically higher highs and higher lows. And the higher lows are certainly a crucial part of that bullish configuration to the chart. We can also, look at the market trend model, which for me is looking at weekly data. It's bullish on all time frames as of Friday's close. So the trend is positive. So what we're looking for is some sort of validation that the trend is no longer positive. What would tell us that this brilliant uptrend is no longer in play? We've been focusing on 65.50. As we can see, we've pulled back to that level a number of times. The 50-day moving average right around that same level. We pulled back there earlier this month. We have now resolved that test to the upside. As I'll reiterate what I've said, if the S&P breaks, if and when the S&P would break below 65.50, I think this is a very different look, because that would be the first time we've not made a higher low. That would be the first lower low since April, since the low in April of 2025. Every move higher we've seen since April has made a higher low on the next pullback. At some point, that pattern is going to change. And at that point, I think you have license to be a lot less constructive about this market. For now, as a trend follower, I'm pretty happy with the pace and the consistency of this uptrend. Even with all the choppiness we've had in the last week or two, we have not failed to hold that key line in the sand. And I think that is crucial right about here. S&P 65.50 remains the level for us. Breadth conditions had looked very dire last week. We covered that as often as we could here with the charts, and certainly with our market misbehavior premium members. We've been digging a lot into some of the breadth conditions and talking about their implications. I would say today with the bounce higher was some pretty decent breadth, as we mentioned earlier in the show. That is meaning back above 50% of S&P 500 members above their 50-day moving average. That broke down about a week and a half ago, and I would say that was one of the big red flags for this particular month, is that we had finally broken below the 50% threshold. We got back above there today. That's super encouraging. If we can hold that, I think that's really encouraging for the opportunity to move higher. But I mean, keep in mind, obviously we're still going down, right? The overall trend in this breadth data is lower. So let's get really excited when that changes. The McClellan oscillator, another breadth indicator, improving a bit, back above zero. That actually just happened for the first time since mid-September. For the last month, the McClellan oscillator has been below zero. That speaks to the fact that the advanced decline lines have been slowing. That is very common at major market tops, which for me has told me have a heightened awareness for key levels of support. Do they hold? For now, they've held. And now the breadth is actually improving a bit. McClellan oscillator back above zero. That's a pretty encouraging sign. Would love to see that continue for sure. Dow theory, and this is actually what I call the newer Dow theory, applying Charles Dow's original work and really modernizing it for the modern economy in 2025, more of a service-based economy. I look at the equal-weighted S&P in the top panel, the equal-weighted NASDAQ 100 in the bottom panel. If these are both breaking out, that's pretty bullish. And the equal-weighted NASDAQ 100 made a new 52-week high today, actually broke above the previous swing high. The equal-weighted S&P has not quite done so. But if it does do so through the remainder of this week, that would be a very bullish, what we call a bull confirmed pattern from the newer Dow theory. So overall, pretty encouraging. All right, we gotta go there. I mean, one of the big moves, when we think about everything that happened today, stocks were relatively flat, besides some individual names, which we'll get to, that were on the move and that we've highlighted so far. Major indexes, not a lot to talk about in terms of directional movements. But I tell you one thing that did have directional movement, precious metals, right? Gold and silver, both deteriorating pretty aggressively today. We knew this day would come, and hopefully, you were mentally prepared, emotionally prepared with the fact that the trend that we've had in gold, the exceptionally strong uptrend phase, the exponential rise that we've seen off of that breakout in late August, it had to change at some point, and I would say today certainly may have changed. Yesterday, we celebrated the fact that the GLD traded above $400 a share, actually closed above it for the first time in history. Today, giving back 6.4%. Today's one-day move basically unwinds the last week for the GLD. So again, keeping in a proper perspective, the kicker is gold has gone up a ton, right? The GLD broke out above 315 and just got to over 400. So we've gained a ton just since the end of August. We've given back a little bit of that, not a ton, but a little bit, and enough for certainly me and others to be wary. So what does this mean? The fact that we've had such an acceleration means we're still above the 21-day exponential moving average. That's how much of an acceleration gold has had. Even with a 6.4% drop today, we're still above the 21-day EMA. My kind of basic back-in-the-envelope rule, unless we break the 21-day EMA, I've agreed to just not be too concerned about it. When that breaks, then we have to revisit it a little bit. I think there's more room for a chart like gold to pull back and still be within a pretty constructive pattern. However, the drop today does, while it does remain above the 21-day EMA, it does take the GLD out of the overbought region. It's been there pretty much since the breakout in August. Gold is overdue for a correction. We can see even during a healthy bull market phase, you'll get pullbacks to the 21-day EMA. Worst case, down to the 50-day simple moving average. Unfortunately, that's a long way below current levels. So I would say between now and then, it's all about your risk and how much of a pullback you're comfortable with. For me, I'm inclined to keep a bet on, as long as we hold the 21-day EMA. We break that through the course of this week, I'd certainly revisit that. Again, we just haven't had a pullback in so long. Pullbacks are pretty normal. And as long as the RSI holds 40 on the pullback, the momentum structure is still quite positive as well. That's what also keeps me, while concerned about the sudden drop in silver. Silver, the SLV down 8.25% today, so even worse. We did close below the 21-day EMA. What do we think about gold? So or silver, when we have a big exponential rise, another thing we can do is use Fibonacci retracements. I have two different frameworks that I will show you here. The first one is taking the July swing low, which is the most recent significant swing low, and then the October high, just above $49 a share, just from last week. We've pulled back almost exactly 38.2% of this way, which means if the short-term constructive pattern is still good, we should hold $43. If we break 43, I think this becomes a much more significant decline, or certainly an elevated risk of a more significant decline. So I think of Fibonacci retracements like this, like an if-then statement. If we would break 43, that unlocks a move down to around 39 or so. The 50-day moving average, all around that 39 to 40 range. We break 43, that would be my downside target and an objective where to maybe reevaluate a position in silver. We can also look at a longer-term time frame. So if I take the April low, which is around 2650, take that same high from last week, 38.2%, almost kind of right around that same level, kind of 40 and change. So this certainly looks like an area that I could expect reasonable support. My question would be, does that support hold, and does the RSI hold 40? If it does, this is still a pretty constructive, tape. If not, then I think we need to reconsider with silver. And I don't have a position in SLV at the moment. I do still have a position in GLD and IAU. I'll be actively reviewing it based on some of those concepts that we just discussed. All right, another thing to think about, right? From mid-September to mid-October, one of the big changes we observed was a rotation lower in the relative performance of some of the growth sectors. Technology has actually been outperforming since mid-September, but communication services and consumer discretionary both underperformed in that 4-week period from mid-September to mid-October. Really, in the last week, though, we're seeing a bit of a hook higher in the relative strength on communication services and consumer discretionary. That is a potential rotation to pay attention to, because one of the big themes we had discussed was an improvement in defensive sectors like consumer staples and real estate, certainly utilities, a rotation lower in growthy sectors like communication services and consumer discretionary. If we get a change, I think that means another structural change, maybe renewed leadership from the growth areas of the market. Keep an eye on those relative strength lines. We certainly will. So keep tuned in, and we'll share with you any insights that we have available. All right, a couple individual charts, and we'll call it a show. Here's the chart of Alphabet, mid-September to mid-October, higher highs in price. We did slightly make a new all-time high in Alphabet on yesterday's session on Monday. But look at the momentum. This is a problem, right? Overbought here in mid-September at that peak. Not quite overbought in early October. Here we're making a new high on even weaker momentum. Classic bearish momentum divergence. Price going higher, momentum going weaker. That divergence suggests we're near an exhaustion point. Today, we traded below the 21-day EMA, but did not close below it. So keep an eye on that. For now, the structure is holding. The price is still good, but the weaker momentum, if that would persist through the course of this week, very dangerous sign for obviously a leading name within the NASDAQ 100 and certainly within the communication services sector. Amazon bouncing higher today. That's great to see. They actually report earnings next week, but we're bouncing off of the 200-day moving average. We've identified this chart as vulnerable because we're testing the swing low from early August. We've kind of double dipped on that level. We've also, traded right at the 200-day moving average. We're bouncing above there. Similar to a previous chart, we're in that limbo between the 50 and 200-day moving averages. Let's see which way this breaks. For me, this is one of those sit on your hand kind of charts. It's not horrible yet because we're still holding support. It's not great because we're not above resistance, but one of those things is going to break. Great opportunity to use alerts and just trigger, recognize when one of those levels is triggered. Tesla reporting earnings tomorrow. For now, I reiterate the technical configuration, pretty constructive. We do have some pretty significant resistance, not too far above current levels. Most recently, we got up to 470. We had that bearish engulfing pattern, which suggested this pullback period of weakness. For now, we're holding the 21-day EMA. It's about as good as you could expect going into earnings. This is a strong technical structure. If earnings disappoint, if we break below that support, serious problem for Tesla. That'll do it for today, folks. As always, I welcome your questions. Please use our YouTube channel. Use the comment section there for any questions that came up as you were watching the episode. If there are any specific tickers we didn't show that you'd like me to consider for a future episode, make sure you drop those in as well. Great episodes of our Market Misbehavior podcast, by the way. We had a great conversation with Tom Atkinson. That's available on the channel. Also, most recent episode, just sat down earlier today with Viva Shah. She was a number of times at the top of the leaderboard of the U.S. Investing Championship. She's done a great job on IBD Live, and my friends there, suggested her as a fantastic guest, and it was an awesome conversation. We'll get that edited up to you and out your way later this week, but a lot of great episodes of the Market Misbehavior podcast available for you to enjoy at your leisure. That'll do it for today. Thanks again, as always, for watching the show. Thanks for supporting me and supporting Market Misbehavior. I wish you a wonderful evening, and remember, it's always a good time to own good charts. Have a good night, folks.